Are we heading for an economic crisis, higher inflation, and more economic pain? Or a soft landing followed by better economic growth and cheaper borrowing through lower interest rates? And what are some of the metrics that you can look at to indicate this? Because my last video looked at the historic price of Bitcoin, the 2024 Bitcoin halving, bear markets and all-time highs, to see when we might see the next all-time high in crypto, which you can find a link to here and in the description. So another question is, how does the cryptocurrency market link with wider traditional finance and economies? And when, generally speaking, does crypto thrive? That's what we'll look at in this video. So please do like the video and subscribe to the channel so I can continue to offer more content for you in future. And let's jump straight in. Japan and the UK have already been in recessions, with more news coming out in February 2024 about countries that are struggling to grow their economies, including Finland, as you can see here, which has also just announced it's also in a recession, as well as Ireland, that fell into a technical recession in the final quarter of 2023. And Germany is struggling also, so there are some large countries here that are finding it difficult to grow their economies. And we're also aware of the conflicts that are taking place in the world today, the disruption to supply chains, political instability, and the fact that more than 4 billion people are eligible to vote in more than 50 countries around the world in 2024 alone. But what is happening with the world's largest economy in the United States? Let's take a look at 6 of the metrics that can indicate the health of its economy. And firstly, as I'm sure you're aware, US debt is at all-time highs at well over $33 trillion. And I actually did a video on just how big a trillion actually is when you compare it with a million or a billion, which is pretty eye-opening. And you can find a link to that here and in the description. And secondly, this total debt as a percentage of the US GDP, or gross domestic product, currently stands at over 120%, which basically means that it's borrowing more than it's making, bringing in, or indeed growing, which is obviously worrying. And if you look back, you can see that debt grew throughout the 1980s as a percentage of its GDP, being at about 30% in 1980 and doubling to over 60% by 1991. And then you can see the large spike during the 2008 financial crisis, where it had only increased from about 60% in 1991 to 63 or 64% at the beginning of 2008. And the interest payments that are due by the US government on that debt we've just looked at have now surpassed $1 trillion, which is a huge amount, with a lot of people basically saying that you can't service this level of debt, so they just kick the can further down the road by monetizing it and issuing more debt that we've already seen. Let's now look at the 10-year versus 2-year treasuries and the yield curve. And to put this graph into simple terms, you can see that when the line goes below 0, it has always preceded or come before a financial crisis, which are the vertical grey lines here. And you can see just how far below 0 we've gone this time. So this would normally indicate that a recession and financial crisis would follow at some point in the future. But what this graph actually represents when it goes below 0 is that interest rates for borrowing over a shorter time frame, 2 years in this case, is higher than borrowing over the long term. And it's 10 years in this case. And this doesn't really make sense, because normally, if I lent you $1,000 or pounds or whatever for 1 month, the interest will be one price. But if I lend you that same amount for 10 years, it will usually be higher, because you're not paying it back for longer. So why does this even happen? It's because whoever's borrowing from you is desperate for the money and will pay more to receive it in a shorter amount of time. And this is called the inversion of the yield curve. And treasury bills have different maturities, so you can actually compare different lengths of time to the graph here. So 10-year versus 3-month treasury maturities, for example. Let's now look at interest rates, because we're all aware of how these have increased which have in turn increased the cost of borrowing. And the question here is, what has always happened historically when the Federal Reserve then lowers interest rates? Well, as you can see here, a recession follows. And you can see here the lowering of interest rates well before the crises, or the grey column, in 1990, then again before 2001, again before 2008, and even before the pandemic back in 2020. So what will happen when central banks reverse course and start to lower interest rates? Well, history would indicate that a financial crisis would then ensue. This then leads to more money printing and debt, which starts essentially the cycle again and further devalues the currencies we have today, whether that's the dollar, the pound, the euro, etc. And finally, let's look at the unemployment rate, because unemployment doesn't normally precede a crisis, unlike most other metrics. The unemployment rate normally coincides with a crisis. Often, as we can see, it's right at the beginning of a crisis, and then it keeps increasing even after the financial crisis has ended. That is because employment and unemployment takes time to action and are often reactive measures based on the state of that particular business or the economy. And as you can see from the graph, when you have a very low unemployment rate, you are normally heading for, or you're in, a crisis or recession, which seems quite strange. So to summarize, I think it's fair to say that the 6 metrics we've seen here aren't terribly conducive to a healthy economy. If you're interested in this and you'd like to see more metrics that can measure the health of an economy, just let me know in the comments below and I'll do another video on different metrics. And what does this all mean for crypto investors? Well, cryptocurrencies are assets. So when quantitative easing takes place, and the central banks like the Federal Reserve print more money, then the price of crypto will increase. And inversely, when interest rates increase, this increases the cost of borrowing, with the aim essentially of removing liquidity from the financial system and reducing inflation. So this will normally decrease the price and the market cap of cryptocurrencies. But it's not all doom and gloom, and there's certainly still hope and opportunity, because we've had all-time highs on the S&P 500 in January and then February of 2024. The price of Bitcoin has increased pretty much since the lows of around $16,000 back in November 2022, surpassing $52,000 in February 2024. And ETH hit $3,000 for the first time since 2022 in 22 months. So things can't be all that bad. And this is why, in my opinion, you should try to take the emotion out of investing, zoom out and invest for a longer time frame, educate yourself and make decisions based on evidence and logic rather than on things like hype, FOMO, or even FUD. So that ends this video on how to identify the health of an economy. But as always, I'd love to know what you think in the comments below. And if you're interested in more of a tailored approach to your general crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.